hit that real quick. All right. So we'll probably just go through these slides, and I want to do Q&A like on the go. So if there's any questions that come up, we can do them in real time as we go through this slide. There's an accompanying webcast that the CEO of Valvoline, their quick lube channels, his name's Sam Mitchell, that he does along with the slide presentation. And I implore everybody to take a listen to the actual webcast, because the webcast gives his personal insight to the slides. I'm going to go through this with my own opinions, and then we'll just do Q&A as we go along. So what this is as a publicly traded company, Valvoline will go out and hit what's in finance, they call it the road show. And it's just a way to drum up interest in institutional buyers to try to get them to buy the stock. And so Valvoline will go to places like Goldman Sachs and present with the hope that their stock will be purchased by institutional buyers such as Goldman Sachs. And Goldman Sachs has this retail conference every year. And then Valvoline has an investors relations page on their website that allows for you to listen to the webcast. You can actually, if you log in on the date of the actual webcast, you can ask a question yourself. Usually that's reserved for analysts, but for something like this, you could easily just hop on and ask any kind of questions that you'd like. And they ask very similar questions to what, some of the potential franchisees and what, the questions that anyone in our space would have about the future of the business. So, it typically starts off with the disclaimer that everything is forward looking, and that's just a financial way of covering your butt. So if the things that they say don't happen, they have themselves covered. The biggest news in Valvoline right now, and this is actually pretty pertinent to us, is that they sold their global products business to Saudi Aramco. And what that means is Valvoline Instant Oil Change is going to be its own publicly traded company. So, when I listen to their quarterly earnings calls, it typically includes all the retail products, the packaged products, and the different verticals that Valvoline has. But with the sale of that part of their company, their earnings calls are going to be much more specific to the quick lube line, which is going to only be more beneficial for us because as a publicly traded company, they're going to have to disclose certain things, which allows for us to see much more specific statistics and trends. There has not been a publicly traded quick lube since Jiffy Lube was publicly traded before Pennzoil bought them. One of Jiffy Lube's franchisees, actually, Team Lucor, which I think is based out of Raleigh, North Carolina. They were publicly traded on the pink sheets at one time. They were such a large franchisee that they actually took their company public within the Jiffy Lube system, but they have since taken the company back private and operate, I think, 130 or so Jiffy Lubes. So the total sale of their global products business is going to make Valvoline flush with cash. And so we're going to see a lot of one thing that Sam Mitchell mentioned was utilizing that funds for shareholder value, which typically means stock buybacks or dividends. But we can certainly assume that this will also mean that they're going to put away that war chest to try to, combat some of the fragmentation that's happened in the quick lube market right now with Take 5 and Strickland and ourselves. This is the most active growth in the industry probably since the late 90s, early 2000s. I have to imagine that they're going to use some of that cash for new locations because they're very close to passing Jiffy Lube in total store count. So they are shifting to a fully service-based business as opposed to being a half and half products, half and half service business. We'll still see Valvoline products on the shelves at Walmart and things like that, but they're putting their attention purely towards the quick lube side of things in their Valvoline Express Care. For those of you who are not aware, Valvoline's business is really divided. Valvoline's oil or services business is really divided into three lines. It's the VIOC, which is the Valvoline Instant Oil Change, the Valvoline Express Care, which is more of a licensing program. And that, anyone with a repair shop like Paul's, auto repair could convert to a Valvoline Express Care, and Valvoline would throw some money at that. And you could convert your store to a Valvoline Express Care and still do normal auto repair. And then, of course, they have an installers program, which all of the major oil companies have, which is just Joe Schmo's auto repair featuring Valvoline oil and filters, things like that. I don't need to go too much into the sale of the global products. This is basically the side where they said that what they plan to use, they're going to retire a certain amount of debt. One place I would have been fairly critical of Valvoline in the past is how much debt they've had on the balance sheet. So this is an opportunity for them to retire quite a bit of that debt. I always assumed that they were positioning themselves to be bought out by one of the foreign majors like France's Total or maybe even Italy's AGIP. But it looks as though they plan on being an independent entity for the foreseeable future, and this sale is going to allow them to be well capitalized to do that. We'll talk about point 4 a little bit later. It's interesting what they classify as a EV service. It's not what you might think. So, a lot of the stuff that they talked about in this particular presentation is a lot of the stuff that we talk about. And it's interesting to watch it as an outsider because they say these things to investors, but in actual practicality, sometimes it doesn't seem to play out the way that they say. If anyone's gone to a VIOC, they still have some of the high pressure tactics. They still have employees whose wages are tied to incentive-based types of methodology, and they have stores that have these high ticket average hurdles that need to be met. And whenever you have a high ticket average hurdle, that means you have to sell more than just oil changes in order to hit those hurdles. And so while they like to say that they're an oil change only model, in actual practicality, I think those of you who have done independent research into Valvoline or have actually gone in themselves know that that's not the case. One thing that Sam Mitchell did talk about is their need to increase their fleet business, and that's a huge opportunity for us as well. And we talk about that at Discovery Day. We talk about it at training. Fleet business can be a core part of the business model to really shore up your revenue, your predictable revenue during the ramp up period. And so I was a little surprised to see this figure that only 10% of their customers are fleet. That just shows me how established Jiffy Lube is within the enterprise and WEX systems. They must be for someone as established as Valvoline to only be 10% fleet customers. Does anyone have any specific questions on anything so far? Because getting right into the tip of it at the moment. So Brian in Frisco just asked in the chat to remind us of our fleet relationships. We right now don't have any national accounts. We don't have that national presence to go after national accounts, but on an individual store by store basis, you can sign up for Enterprise and WEX. It's a secondary point of sale system that has a monthly fee attached to it. But essentially anyone can sign up with Enterprise or WEX for fleet services because they have these credit cards that are tied to these specific fleet programs. And what happens is your site will go on a list, and that will allow for fleet managers to see your name on Enterprise. And so that is not something we're currently from a fleet standpoint, that's not something that we're currently putting a lot of man hours into until we have more scale. Right now, local fleets are a much better option for building the business, and that is just purely, pounding the pavement, going out, doing the grunt work, and reaching out to local businesses to find those fleet accounts and multi-vehicle accounts. If we could have everybody on mute, I'm getting some feedback, so I just want to make sure that there's not that noise in the background. I don't know if I have the ability to mute people with our Zoom account, but maybe. All right. So that's a good question, Brian. We have a whole fleet training aspect to the business because fleets can really quickly build up the business and mitigate that ramp up period. And we put a lot of the onus on our franchisees, on our managers to go out and cultivate those relationships. If they see the vehicles driving by the shop, internally we have them write down those names of those businesses on those vans or cars, and then they present those names to us in the back office, and we'll call them and offer them discounted programs based on volume of coming into the stores. So Valvoline has hit on this slide that we're on right now. They've hit on some of the things that we've talked about in Discovery Day and training. Is the average lifespan of the vehicle is the longest it's ever been, and the level of skill required to do the job within our business is not nearly as high as full service mechanic shops. And so we haven't been as hard hit by some of these labor trends because the oil change is such a specific and I don't want to say low skilled task, but it's certainly not as difficult as replacing a timing chain. So Valvoline does provide other services in some of their stores that are higher skilled level, and Valvoline typically does pay above average wages for the industry, but that is mostly because they're in this consolidation mode where they're trying to pass Jiffy Lube and store count. Their revenue has been on a steady growth pattern for quite some time now, and that largely has to do with the increase in stores that they've added. That being said, their same store sales are also growing as well. And what Valvoline, if you were to listen to the webcast, what Sam Mitchell attributes this to is basically the strong brand presence that they have. And that Valvoline, they like to refer to it as the big V. When Valvoline puts up that sign, they believe that they inspire trust and confidence versus some of the competitors. And I think in a lot of places that is true. In other places, not so much. So this 1,600 number includes, I believe, the Valvoline Express Cares. As far as VIOCs, I don't think they're quite there yet, but it shouldn't be. By the end of 2023, I believe Valvoline will most likely pass Jiffy Lube with total retail locations. They keep a nearly 50-50 franchisee to corporate store percentage, which is but they also, it was interesting on this call, Sam Mitchell mentioned that they purposefully make franchising extremely expensive because they don't want to have essentially mom and pop operators. They want large sophisticated operators like private equity to be running their franchise locations. So their franchise locations are almost an extension of corporate stores. This is just, their explanation for their moat, what makes them different. I I think that they say a lot of the things that a lot of the quick lubes say. But again, sometimes in practice, I don't think it actually comes across that way. So right now, the percentage of revenue that is derived from oil changes within the VIOC footprint is 75% of revenue. It was interesting to hear on the call that they plan on increasing non-oil change revenue. They really talk about doing new EV services, and I'll talk about that right now while it's here in front of us. You know, their EV program that they've spent a lot of money marketing, and it's interesting that they call it EV, literally just consists of 12-volt batteries, wiper blades, and cabin air filters, and tire rotations. And so they're dressing up something that a lot of quick lubes already do under the guise of electric vehicles, just to be first to market, to have a quote unquote EV program. But I don't think that I think that very quickly people will catch on to that, but they probably won't really care at that point, because they are really the only quick lubes that is having a quote unquote EV program. Jiffy Lube's doing something similar, but not nearly to the extent that Valvoline's been doing. You know, I would love feedback from you guys. Maybe I'll send a poll out to the franchisees asking if you think it would be worthwhile to put out some marketing materials saying that we offer these quote unquote EV services, because we do wiper blades, we do air filters and cabin air filters, and you know, we're not in a place where we're doing tire rotations at the moment, but all of our buildings can be outfitted with these quick lube lifts. Some of the open stores that are operating right now for us have them already. So it wouldn't be out of the realm of possibilities, but that is something I would rather approach when the percentage of electric vehicles exceeds 10%. Right now it's at about 5%. Tesla just released their earnings, and they missed deliveries by quite a wide margin. And I think that the political climate is also shifting a little bit. So I think that will delay things out at least another 6 years. But that is to be seen. This is an interesting point for anyone, including us, is the source of new customers. I think that, you know, Valvoline on this call, Sam Mitchell on this call mentioned Jiffy Lube by name several times, but he also had inferred about some of the new competition, which would most likely mean Strickland Brothers, us, and Take 5, potentially Grease Monkey, but I don't know how relevant they are anymore. But Valvoline is pulling 24% of their new customers from other quick lubes, but their biggest place that they've been getting customers is car dealers and tire and repair. They a lot of the Valvoline stores do not do inspections, and that leads to losing a certain segment of the customer base on a monthly basis, which they at the moment are okay with, because a lot of the time, you know, if the customer needs to get an inspection and they go to Midas will just throw in the oil change while they're there, and that disrupts that cycle. So for us, I would imagine that our percentages would more or less reflect these same percentages in terms of where our new customers come from. I'm going to speak with some of our managers, because we do pull some data in terms of prior service, and we can look at that and come up with our own percentages. The do it yourself is the hardest one to actually calculate. Does anyone have any questions on this? And if you want to ask a question in the chat, I'll just read it back as well if you don't want to come off mute. So DIFM just stands for do it for me. That's essentially our market. That's where we want to live, is the do it for me market. And Brian, yes, we could definitely send this. I think I put a link to it in the Slack channel. So everyone who's on this call, I'm assuming, is on Slack, because that's where I posted this invite. I invited everybody on the email list. So, but definitely if you're not on Slack at this point, get on Slack. A lot of good information gets posted there, but I can email this PDF out as well after this. So do it for me is where we live, but one segment of the customer base that we are grabbing is the do-it-yourself market. And this is largely a generational thing. And Valvoline did not touch on this during the call, but it's something that I'm starting to see a lot more, is the generational gap as we move to these Gen Y move out of millennials and Gen Z. They are the least likely to want to do these types of things themselves. And so an interesting data point is the amount of Gen Y individuals that are joining the driving force actually outpaces the sale of electric vehicles. So our business is actually in a state of growth. Our industry is in a state of growth because although electric vehicles will eventually grow to a much larger percentage of the cars on the road, if the amount of people who join the driving force outpaces that, and those are individuals that want their oil changed for them, then we can reliably say that the industry will have more of those new customers. And people are living longer than ever. So boomers that are retiring and may not be driving as much, they'll still be having their vehicles for the longer periods of time, especially with how long these car loans have become. And it's also, I'll add this note. It doesn't really have anything to do with this presentation by Valvoline, but cars depreciate the moment you drive off the lot. And so for a lot of these people, their car is on an 80+ month loan, and it's underwater almost immediately because they're putting the minimum amount down. Those cars are going to have to be maintained for 14+ years, essentially, because they're going to be underwater and not able to get out from underneath servicing that vehicle. They're not, unless they take a hit on it because of the negative equity. So just another side note to this whole electric vehicle conversation. Valvoline is of the opinion that hybrid electric vehicles are going to play a larger role, and that, right now some of the fully electric vehicle rhetoric is politically driven. And Valvoline also sees a huge opportunity for fleets with the medium duty, which is those Sprinter vans. And I don't know if they're talking specifically about Amazon or FedEx or UPS or just in general, but they see a massive opportunity in medium duty fleet accounts. And so I took note of that myself to see if there's some trends changing there. I know Amazon is investing in some of the newer technology vehicles, and Amazon would love to get away from having human capital at all. I sent that email out about us, putting in place third-party resources and outsourcing quite a bit of human capital to streamline our process. I don't think anyone in the world does it more than Amazon. And so I think that if Amazon could run its business with, just robots, they would. And so I think that's the direction that they're going. I had a conversation with a multi-unit Midas franchisee the other day based out of Philadelphia. And he was telling me that Midas is investing a lot of their money into training the Midas franchisees on the ADAR, which is the advanced driving assistance software. And so they think the future is self-driving cars, not electric cars, which is interesting. I don't necessarily agree with that, but just kind of a mental note that that's what Midas is doing based on that anecdotal point. I don't really need to bore us with Valvoline's financials. They're growing, and at the end of the day, they see themselves as a leader in this space, and they plan to get to the point where they are the highest retail count. And retail count's really a vanity number. If how many oil changes you do is really more important. And that's really it for this call. Like Brian asked for in the chat, I can definitely share this with you. These are just disclaimers around it. Any other questions on any of this? And we can kind of open it up to open dialogue if anyone wants to have a conversation about it. If not, we will post this recording on YouTube. And if anyone has any other questions and want to email me, we can do that as well.
Hey, Costa, Brian again. Hey, just really quick, I'm curious. You're out, and I got to do a better job of this. So I appreciate this info. Like, right, Take 5, these other guys. What do you trends kind of seem to be the same across most of the competitors? Anything else that may uniquely stand out?
Yeah, Take 5 is a little bit of a different business model because they're more real estate driven. If everybody were to go on to Crexy and just type in Take 5, their revenue and is more driven from this resale of large leases. And so Take 5's growing incredibly quickly, but it's only because they want to put buildings up so they can package it with a large net operating income to the lease and then sell the building. Driven Brands is a publicly traded company, so there should be some information out there, but there are larger brands within the Driven Brands product line or service line that kind of overshadow the earnings calls. So I haven't been able to really get any meaningful information from Take 5 other than anecdotally just seeing what's happening in the space. And same thing goes for Jiffy Lube. Jiffy Lube's owned by Pennzoil, which is owned by Shell. And I can't remember the last time Shell has even mentioned Jiffy Lube on one of their earnings calls. So it's tough to find that information sometimes.
Okay, thanks.
I've got a question in the chat from Bran about the Getty poll that I sent out. I finalized our dealings with Getty over the weekend, and so that is basically going to be an internal business decision on our part. I think I'm going to structure a new poll just to get people's feelings on a different way of positioning it. But at the end of the day, it was very interesting to look at the results because some of the more, I don't want to say sophisticated franchisees, but some of the franchisees who have been in business and are a little bit older, voted yes, strongly. And there weren't very many people that said no strongly or no ambivalent. And the comments were really interesting because, what little brand equity Getty has left, for me, it would just be one less barrier to a conversation with a potential franchisee or a potential customer is to say, okay, this is, Getty. But, every day that brand is not being used, it loses a little bit of its brand equity. And there hasn't been Getty products in such a long time, whereas, we're starting to gain a little bit more traction on our side of things with the Costa Oil branding because we do sell direct to consumer online. One interesting note is that I also polled all 58 of my employees the same way that I polled the franchisees, and 100% voted no strongly. Not, some no ambivalent, no, it was 100% that responded to, and it wasn't all 58, it maybe was like 13 that actually responded to the poll. They all voted no strongly, which was an interesting kind of data point to put aside. So I don't know what we're going to do. Converting the corporate stores would be a huge capital expense. And so that is a part of the decision-making process as well. And then obviously we have 6 stores that are open at the moment. So those franchisees would have to also convert as well. But in any case, I'll end with this. I view the Getty IP in a similar way that I think Jiffy Lube utilizes Pennzoil. I think we could kind of have the best of both worlds, where we do a Costa Oil featuring Getty and kind of tie the brands together so that they're so closely associated, they're synonymous. And that's what Jiffy Lube has largely done with Pennzoil to an extent. I think that's an opportunity that's lower hanging fruit and not as expensive. So, that might be an opportunity as well.
Hey, Casa, I actually like that. I didn't think of that. My only thought, I grew up in New York, so I was familiar with Getty.
Yep.
But to your point, right, it's been so long. I didn't know if it was regional or not. I'm in Texas now. But my thing on it, the decision, right, is like, is there any like market data that could help us, right, derive a decision, right? Just get a better understanding of the market, how they think of that name, because at the end of the day, that's what really comes down to, right? Is there equity in the market or not? But I like your idea there at the end.
Yeah, and so that's a great point, Brian, because the only market driven data that I have is based on polling through different social media channels like Twitter or LinkedIn. And even then, that's a bias because my network is very petroleum oriented. And so people are more likely to have remembered the brand. And we had several franchisees who also talked to their spouse and children, and they added in the notes like that they either thought Getty was an images company or, they thought of the museum. And so that's, at one point in time, 1984, Getty was the fourth largest company in the entire world. And so it fell from grace pretty heavily, pretty quickly. And I think people that are Northeast based would remember it a lot easier than the rest of the country. But again, all other variables being equal, it is, a former national brand that could be one less barrier to someone saying no to our service.
I will say our branding is better though.
I agree. I think there's an opportunity. I think the featuring program could be an opportunity. I'm dealing with some blenders right now to see if anyone would pick it up as a house oil, because the more that the name gets back out there, the faster it could come back. So there's some opportunities, and we'll continue to have that conversation internally. Does anyone else have any questions, or anyone want to talk about anything on this slide deck before we close for the morning? All right. Thanks everybody for joining us. I appreciate it. This will be up on YouTube relatively shortly. And I want to try to do stuff like this more often. There's just not a lot of content out there for the quick lube space specifically, but I'll try to find more stuff to have these kind of calls, because I think they can be really helpful, especially as these stores begin to roll out more frequently, and they're about to happen relatively quickly. So I appreciate everyone being on the call, and have a great rest of the week.